What's up, everybody? Today I have Nicole RUETH talking about the recent rate increases. As you know, we've had some interest rate increases that are affecting the headlines and the psyche of some people looking to buy or sell in real estate. So no one better than Nicole RUETH, the chair on the DMAR Market Trends Committee, as well as the #1 lender in the state of Colorado, to discuss her week and how it's been and what this means for buyers, homeowners, and investors, all from a positive light. So can't wait to dive in with her. As always, please like, comment, subscribe. Please reach out to me if you have any questions. I will link Nicole's information in the comments below. So if you do have questions or want to follow her on social, she is always such an amazing source of economic and real estate market news. So without further ado, let's dive in. All right, so excited to be joined by Nicole RUETH with OneTrust, the RUETH team at OneTrust, a new home for them. But more importantly, just wanted to talk to you guys today about the news and the headlines that you've probably seen. Nicole, how was your Monday this week?
It started last Thursday, and then Friday was relatively calm, and Monday was a mess. Bond prices were off 155 bips, so it was just awful in every way.
What's that mean in layman's terms, 155 bips? What are some numbers that you're seeing?
Right. So when we see 155 bip drop, so that's 1.55. So when we see that dropping on bond prices, that means yields or interest rates go the opposite direction. So they were going up, and all of a sudden, people were getting quoted 7 1/8, 7 3/8, 7 1/2, depending on your situation. So on Saturday, I had sent out a blog talking about the fact that we could see rates with a 7 handle. And sure enough, on Monday, we did.
All right, so we did. So obviously the headlines have kind of taken on that, and I've talked to agents and people all over, and they're like, well, does this mean a crash? And when I hear these things, I really like to step back and take a look at what it really means. And more importantly, right now, what's it mean for kind of the three groups that you serve, the renters or the first-time home buyers, the homeowner who's maybe moving up or downsizing, and then investors. And I think that's kind of our buyer pool divided in the most common terms with ease. So what's this mean for that? What's it mean for our market as a whole? I will go out there and tell you, I don't see it as a crash. It's definitely going to continue to slow and ease, I think, but just want to kind of talk from a positive perspective, what the opportunities are for each of those groups.
So higher interest rates don't mean a crash by any sense of the imagination. They simply mean that demand will slow, and exactly what FED Chair Jerome Powell had sought to do is happening. He sought to reduce demand to allow supply to catch back up again and to right size the housing market. So we're nowhere near a balanced market or a buyer's market. We still have very limited inventory. We haven't even hit 2019 levels. So a crash doesn't necessarily equate to higher rates, but affordability does. A rate with a 7 handle for a first-time home buyer, or any home buyer for that matter, is going to be important. But what you really have to focus in on is the monthly payment. The monthly payment, yes, has gone up from when an interest rate of 5.875 or 6 to 6.5 to 7 to 7.25, that is going to impact the interest rates. Now, the jump that we saw on Monday won't last forever. We already saw a little bit of a pullback today, and it will be a volatile market. So as a buyer, you can't, especially as a homeowner, right? So we're not talking about investors. We're not talking about other classes. We're talking about that first-time home buyer or that home buyer that's moving up. You have to get focused on what is the payment. Does the payment fit my budget? Is it an acceptable payment for this home that I'm buying? Do I think that it makes sense for what not only I can afford, but what I think this home is worth? And focusing on that. And yes, there will probably be refinance opportunities next year as we tip into a recession. But you can't count on that. You count on what you have today, And then when that happens, you have the opportunity to improve your situation, but really focus on what is that monthly payment, and then how do I improve it? Do I put a little more down? Do I get rid of mortgage insurance? Do I improve my credit score? Do I look at other program options? Am I talking to a lender that's getting creative and looking at all those things for me? Are there ways that we can twist the knobs just a little bit to make it a little bit monthly payment a little bit lower?
Yeah, and that's kind of where we're at, is the monthly payment. And what I talk to a lot of people who are in that first time home buyer situation is, no matter what happens, like, it just hurts my heart when I hear people say, well, I think I'm going to rent for another year. And you and I both have been screaming from the mountaintops. Home ownership is a passion of both of ours, clearly, and also our careers. So, but when people say that, they're like, because the interest rates are 7%, I'm going to go to my famous, renting is 100% interest rate, and literally people are concerned about maybe $100 a month from, Thursday to Monday on a monthly payment because of the interest rate increase, but they're literally willing to throw $24,000, $30,000 away and get absolutely nothing in return. And so that's where I kind of bring it back down to the renters and kind of talking, and we were talking before we started about the opportunity, and don't be the investor's opportunity, because investors are still looking at stuff. They're still waiting for deals. It's not, their cap rates aren't amazing right now, right? But they're still walking into options, and they see panic frenzy when they see these headlines, and people are like, oh, the market's going to crash because the interest rates are higher, when really we're backing off and saying, well, they're just waiting for someone to sell it at a stupid low price and, get out from under it and have that opportunity. So, and then for homeowners, right? You said today that, homeowners are the safest in our economic climate. And can you kind of dive into that a little bit, and why you said that?
Yeah, so homeowners, we're talking about the fact that the economy is going into recession. The globe is going into recession. We're seeing Europe going into an energy crisis. We're seeing Russia and Ukraine. We're seeing China is kind of a mess right now. So we know that overall we are seeing an economic slowdown. But the homeowner, especially if they got in before this year, the homeowner is sitting on a lot of equity. Not only do they have a lot of equity that is mostly untapped, that's sitting in their home protected, even if they lose a little, gain a little, lose a little, gain a little, that equity is still sitting there, and their monthly payment is locked in probably at an interest rate under 4%. Because 75% of those who have loans have an interest rate under 4%. So they have an inflation, they absolutely have a guarantee against inflation with this hedge called a mortgage payment locked in at rates that we saw over the last 2 years. So homeowners are in the best position of all Americans right now.
Right. And that's something to consider, because we talk a lot about the inventory that's coming and future pacing the inventory. And when these interest rates are higher and people are starting to buy, the investors take advantage of that as well, because they're going to start charging more in rent. I mean, you and I both as multiple unit owners know that, we try and keep it real, but it's easy to get more money in rent right now. And as you continue to increase the payment of that entry level investor, that's what because if a homeowner can pay $3,000 for their mortgage as a first time home buyer for a townhome, well, then they're probably going to pay that for rent, because that's where we need to season them and get them to anyways. So then all of a sudden you can get $3,000 for rent and you have a $1,800 payment, and that looks pretty good, right? As a homeowner, if you do want to move and you do, maybe that offsets your higher interest rate there. So that's super interesting. And if the homeowner's looking to sell and move up, I always talk about being in the same market. And you referenced it a little bit there. It's like monopoly money, right? Equity isn't isn't real. It's not like I can go buy anything with it. So just because my home appreciated 44% and maybe we're back down, we lost, $20,000 over the last, couple of weeks because the outliers are kind of becoming more outliers and not the norm. We didn't lose that cash, right? Our bank account didn't lose that. So if I sell at that time, then I'm hopefully going to get the discount on the buy, right? Because I'm buying and selling in a similar market. So that's kind of something that we do, we talk about. So back to the investor piece, what are you seeing investor clients do? How particular are they being, and what do you see their forecast, and what are you seeing that as in the market? What's going on there?
So investors it depends on what your focus is as an investor. If you're looking at a 7.25% interest rate or 7.5% interest rate as an investment property today, then you're immediately going to the fact that that interest rate is higher than my cap rate, so it doesn't make sense. And so you'll probably walk away from that deal. A lot of times when I work with investors, and Jeremy, you and I work together with a lot of investors, that it really is less about cap rate. In fact, I don't personally look at cap rate at all. It's less about cap rate and more about goal setting. So where do you want to be? So if you're 30 years old, 40 years old, 50 years old, and you want to retire at 60 years old or 70 years old, whatever that goalpost is for you, and where you are today, and what kind of income you want then. So if I want a net wealth at this point in time of $5 million, and I want an income of $40,000 a month. I'm totally making up numbers. But if this is my goal, and I'm purchasing investments that over the long run, no matter what the cap rate is, if they continue to have positive cash flow, and we are seeing that because we're seeing increase in rental incomes. So if you've got a property that you can house hack, that you can rent out an auxiliary dwelling unit in the backyard, that you can rent out a mother-in-law suite downstairs, that maybe you rent out the garage to somebody other than your tenant. I mean, there's all these ways, whether you long-term rent it, 30-day corporate rentals, or Airbnb it, compiling those options and creating more cash flow for this investment. While your tenants are paying your rental income, you're seeing a principal reduction in your mortgage because you're paying that mortgage every month. You're seeing a principal reduction. At the same time, you're seeing small increases in appreciation this next year or two, but then it'll start to gradually move back towards historic norms. And then over time, in the next 15, 20, 30 years, you will have gained incredible net wealth as well as income opportunities. So to sit on the sidelines right now while we're waiting for an erroneous, and I'm not completely pushing it to the side, but an erroneous cap rate, which I know helps distinguish between different investments. But if that's what you're waiting for to turn so that your cap rate's higher, meanwhile, you're sitting on the sidelines, not even getting the little bit of cash flow, not getting the principal reduction, not getting the appreciation, you're delaying that inevitable goal set that you put up for yourself. Those goalposts keep moving further and further back. So that's really a way that I like to look at it from an investor perspective, especially a first-time investor, or maybe you just want to buy 2 or 3 or 3 or 4 because you don't have big investor appetite goals. You're not, you don't have any shares that you've sold in this company, or it's not an industrial level investment company. It's you and your spouse and your kids. And what does it take to support the kind of retirement that you want to build is different. It looks different than one of the massive investment companies. They have a lot of mouths to feed and a lot of shareholders to support. You have your family. And it's about, do I have even a net positive cash flow that I can pay for the maintenance and the management of that property? And over the long run, will it gain in value? Will I have principal reduction? Will I have opportunities for cash flow and opportunities to cash out some of that equity down the road, tax-free, because I can do a cash out refinance with no tax event. So it's just about options that an investor can't have access to unless they get in. They've got to have that first purchase to get in to start to build up those options.
Yeah, and I think ultimately we've been pretty spoiled over the last couple of years, and real estate has been more on the instant gratification, sideline. So I think now we're seeing a distinct difference between crypto and real estate, because now it's back to the long term, right? The long term is really what it's about, that long-term vision that you do so well outlining. So if I'm a first-time home buyer and I am facing these interest rates with the 7 in front of them, what are your kind of words of wisdom to those people who are looking to make that change and get into something, and why, right? Why is now the time versus waiting till next year or something of that nature, even though there's 7% interest rate?
Right. So I remember my first home was higher than 7%. When I got to refinance it into 7%, I celebrated. I was pretty excited about that. Now, I also respect the fact that nationwide, we did see a 44% increases in our homes over the last couple of years. We saw a massive increase in our home values here in the Denver metro, and every major metro was seeing that. And so I know that it's coupled, right? It's not just the fact that I've got an interest rate at 7%. I have an interest rate at 7% on top of an increased home price. But I will tell you that the home prices are not going to go down. So it is a thing that we have to get accustomed to, is what are these new home prices? We'll see a little shift, we'll see a little pullback. And so this year, instead of seeing the double-digit appreciation that we saw in 2021, we'll see something more rational. So it started out over 20% the first quarter of this year, and we've slowly been giving it back. So we'll end the year in single digits, which is healthy. We need that. So we are not losing value. We're giving back some unrealized gains. So as a first-time homebuyer coming in, I would say it's not a game. You're not day trading. We're not looking to buy on the dips and get in when the getting is good and make sure that interest rate is the best. We are buying a home. We're buying a roof over our head that long term, even in 2019, we had barely over 2% appreciation. There are years where we have soft appreciation, which we will probably have next year, and then it will go back towards historical norms. Jeremy, you helped my daughter purchase her first home, 21 years old, $525,000. And we put down a small down payment to support my daughter getting in. I ran the numbers for her, and at a 3.8% appreciation, which is the historic norms was 3.6 before 2020. So we upped it to 3.8. It's even higher than that after 2021. But I said, okay, let's just stop it at 3.8. After 3.8, she has well over $1 million in net worth from that home appreciating and added to the principal reduction. So that one home in 20 years is now worth not 525, but more than double that. And she didn't pay any more than the $30,000 that we put down on that home. So that's the kind of thing where she can, at age 41, she can cash out refinance, again, tax-free, or she could sell it and pay the taxes, or she could just live off of the rents. It's about options. So to first-time home buyers, I tell you that you might not be thinking about it as an investment yet, but it very well might be the perfect first investment that you first live in, because maybe it's not the perfect home. Maybe you can't get into the home that you really want because home prices went up and so did interest rates. So now that home that you really had your eye on is a little bit out of reach. So I would say think bigger than that. Think about opportunities. Think about where that home can get you. Think about the opportunities to house hack and the other things that we talked about earlier. And focus in on the monthly payment. Don't focus in on the 7 handle, because overall that's not an awful interest rate. It's just a hard interest rate with affordability. Focus on the monthly payment, focus on being in the right location, focus on an area that you can continue to grow into, and focus on an area that might very well be a fabulous investment 2 to 3 years from now, especially if you can refinance it before that as your primary home, when interest rates drop, lock in an even lower rate and cash flow even better when you convert it to a rental. It's about options.
Absolutely. And, we'll kind of wrap up with this. It's definitely from what you just said. It was all the entrepreneurial stuff that we look into and all the talks and the podcasts and stuff it's all about looking forward, right? It's about looking forward. We can't look back. We can't look back at 2.675 interest rates and be like, shoulda, coulda, woulda, because we didn't, or you didn't, or whatever. And so I think that's very important to future cast it. And if you're sitting here looking at those lower interest rates that hopefully will never be around again, below 3 at least, then we're missing all the opportunity of the future. And with that said, I always say that real estate is a shelter, like it's a necessary need. And as you continue to, relate this to your daughter's story, no matter what her interest rate was, although it wasn't 7%, she's not paying that. Somebody else is paying the interest rate, when it becomes that investment income property. And so if you're not paying it as a homeowner, you're paying it as a renter. And that's the whole point of all of this is no matter what happens, if our average mortgage payment is now all of a sudden $3,200, which we're approaching those numbers for real, then that's what the rents are going to be eventually. And as we kind of, conclude, that's the take home. So I appreciate you so much. And, I was just talking to, one of my clients, and he came to me with a lender, and I said, in this market, Nicole and her team are creative, they're ahead of it. And just thank you so much for everything you do for my clients, for the realtors in general. And I also saw one of your emails that had rates quoted, and it was all the way down. It had, a couple buy down options, but what it also had is when's your break even point? It was, okay, if you buy it down this much, your break even point's at 36 months or whatever. And so it's the whole story. And that's where the creativity comes in to get people into homes, get them out of renting, get them into home ownership so that they do have options. Because if you continue to rent and interest rates continue to go up and prices continue to go up, even though a little bit, forecasted for 2023, you limit those opportunities the longer you wait. So where can people follow you constantly all about the market? So where's the best place to follow you, Nicole?
We post a lot. We post on all the socials. So if you Google search on any one of the socials, Nicole Rueth, you'll find us, or at our website, theruethteam.com.
Perfect. Thank you so much. And we'll talk soon.
That was fantastic. Thank you.
Wow. An amazing perspective on maybe not such a popular topic. Thank you so much to Nicole Rueth. I will link her information in the bio below. If you are thinking about buying, about selling, and want to talk about the local Denver market, please comment below and I can reach out and we can discuss your situation, because at the end of the day, the market is just a bystander and we want to make sure that you're doing what's right for you, right home, right price, right time. So thanks so much for tuning in. We'll catch you next time.